Ladies and gentlemen, it is Fed Day, January 29th, 2020. This is Joe McHugh, your American candidate for President of the United States, reporting on Liberty Strikes Back podcast on YouTube. I was in the middle of making another article regarding the Fed policy, but because today is Fed Day, I figured I'd just jump right into it and share with you what's going on. Here's an article on CNBC that came out on the 18th. So we're looking at 11 days ago. Stocks appear detached from reality, rallying for two things that may not happen. This is an excellent article that talks about, and yes, that is an appropriate look for the face for people who might agree with what I'm about to show you. The stock market has been going up, up and away, right? So we hit a kind of a bottom here in the S&P at the beginning of 2019. You might recall at the end of 2018, the stock market fell through the floor pretty hard, and then it's rallied just as hard ever since then. And if you see here, what you have is a head and shoulders top formation. You have 1, 2, and 3 type of stalling peaking patterns, and then it seemed to have broken through right there. So we're going to talk a little bit about why that is. So it shows here that earnings growth is happening despite poor earnings in 2019. The stock market prices continued to rise, and so here's another chart. And again, I'm going to go back over these charts in a moment. I've taken each of the charts and I've added some commentary and some graphics to it so that you can understand what you're looking at. But first, I want to talk about and go through this article from start to finish here. So the PMI, Purchasing Managers Index, right? It's a measure of the manufacturing sector. If it's above 50, that means manufacturing sector is growing. If it's below 50, that means the manufacturing sector is in decline or contraction. And so the manufacturing sector, along with the transportation sector, is typically used as an indicator of the performance and health of the economy. And so you see here that we've stayed above 50 pretty much the entire time since the 2008 crisis. Okay. And then right here at the beginning of this is the market 2019. So right at 2019, so about halfway through 2018 is when manufacturing started to turn negative. And so if we go back to the half of 2018, you can see, okay, this is the earnings growth. We're still growing. And then so the manufacturing was kind of a leading indicator relative to stock price in this situation. Manufacturing started to turn negative, and once it hit 2019, even though stocks continued to grow, the manufacturing sector actually crossed over the stock performance and started to decline. And once it hit 2020, that's when we first got below the 50 mark on manufacturing. So manufacturing is actually now in a contraction or recessionary type of performance. And that's important. It's important to understand why then the Fed, starting in 2019, would essentially kick off or restart quantitative easing without telling anybody that that's exactly what they're doing. So in October, they announced a $60 billion per month purchasing program. And in case you're not familiar, you don't recall exactly what the quantity of the purchases were. 60 billion was about the average. And as a matter of fact, if you take the point at which we started quantitative easing in 2008 and you ran that through 2014, it works out to about 55 billion per month. So the 60 billion per month is actually above the average in terms of purchases per month made during quantitative easing for those 6 years. And so the effect on that is that you have had a growth in the stock market performance, which is this blue line here. Since the announcement of the quantitative easing program, the stock market on the S&P is up 12%. Now, the QE, or the Fed balance sheet, is up 10%. So the performance of the market is more or less up in lockstep with the addition of or the restarting of the quantitative easing program and the expansion of the Fed balance sheet, which they had been committed to reducing up until recently. So, some of the comments, again, I'm your average Joe. I'm a a desk jockey, economist. Let's look at some people who have a little bit more experience and maybe perhaps a little bit more credibility than I do in this space. This is the gentleman featured again on CNBC, chief economist and strategist of his own company, Rosenberg Research. The primary driving force behind the advance is increased liquidity and money flows, massive injections of funds into the systems by central banks. In other words, the growth in the value of the stock market is the result of the amount of money that the Fed is pumping into the system. Now, here's a chief equity strategist of Morgan Stanley, okay, right here. Chief equity strategist of Morgan Stanley. And what Michael Wilson has to say is whether one wants to call it QE or not, we believe this excess liquidity has suppressed volatility to extremely low levels. In other words, it's a slow and steady march upwards in the stock price with very little swings in between there. And so even on Monday when we had a 450-point drop, that was only a 1.5% drop. And so you really ought to be measuring these in terms of percentage drops as opposed to point drops. Now, I want to show you what I put together. I was working on this article. It started off as an article to describe why Liberty can't wait, and then I ended up writing more about what's going on in the Federal Reserve, and as well as some findings which I'll share with you in a subsequent post about unemployment figures and whether or not they're actually accurate, which I don't think they are. But here is the Federal Reserve is rigging the market once again, and this is the same chart that we looked at just a moment ago, except I've added some commentary and analysis. And so what you're looking at here is this red line measures from the top of the earnings per share growth at the end of 2018, start of 2019, down to Q2, Q3. You probably could have taken it all the way down to here actually, but you tend to measure the actual lines, and so connecting from one to the other. And so what you see is a steep decline in earnings per share growth in 2019 until it effectively flatlined, which is where we're at right now. At the same time, while this steep decline in earnings per share growth is happening in the companies that are listed on the stock market has trended upwards, continues to march upwards. Okay. Now, what that means is that this here is called a bearish divergence. The difference between the trend in one versus the trend in the other, if they're not going in the same direction. For example, the quarterly per earnings share is going down. You would expect the stock market to be decreasing as well. If the stock market is doing so well, you would expect an increase in quarterly per share earnings. And that is perhaps what this article is trying to point out, that maybe the market is rallying on expected increases in 2020. But there's really no evidence to show that that may be the case, at least not yet. So this is what you call a bearish divergence, and it typically happens in advance of a sharp correction in the market. Now let's see if that bearish divergence shows up anywhere else. Now, if we go to look at the purchasing managers or the PMI, you can see that we have, again, a bearish divergence. Again, this is, whereas before it was in quarterly earnings, now it's in manufacturing sector, production, the purchasing managers index, which is reflective of manufacturing health. And again, the red line shows that it's a steady decline, which is not good for the economy, and yet the S&P has continued to rally. Once again, this is what you call a bearish divergence. And the bigger the divergence gets, in other words, the more distance between one and the other, between the top line and the bottom line, usually that portends a more severe correction. So the fact that this is continuing to widen is concerning. Okay, so now let's look at the balance sheet and let's look at that relative to stock price and see if there are any concerns here. Okay, so what you have here, according to the CNBC chart, is what you have a head and shoulders top. So you have a head in the middle, which is a higher price on the chart than both a left shoulder and a right shoulder. But again, this chart doesn't show what happened before August of 2019, and it really doesn't show a very well-formed right shoulder. So I will show you what that looks like on a better chart of price action. But what I wanted to point out was not only this head and shoulders top pattern, which is also a reversal pattern. It's a very reliable reversal pattern. And if you tend to go short on a head and shoulders top or go long on a head and shoulders bottom, you tend to make money on a very consistent basis. This right here, this where they announced their quantitative easing, is precisely where you would expect that decline in the market to have begun based off of that right shoulder. Okay, and so by pumping the market full of liquidity against supply versus demand, anytime you increase supply of capital in the market, you're going to get an increase in price, and that is exactly what happened here in the market. You have an increase in the Fed balance sheet and a corresponding increase in the asset prices as measured by the S&P. And again, right here, from August of 2008 through 2014, averaged $55 billion per month, and this program is $60 billion per month, more than $5 billion more than what they averaged in the 6 years in which the quantitative easing program was in full force. So here is a chart from Macro Trends, and it's a chart of the S&P daily price performances, daily price chart. Okay, so this goes back to roughly the beginning of 2018. You can see that it reached a peak here towards the end of 2017 and the start of 2018. At this point, you may recall that Bitcoin was also peaking, and it crashed pretty hard shortly thereafter. So there is what you would call a climax top or a blow off top and a sharp correction. And if you were to draw a line here, you would see potentially a rebound, and that's exactly what happened. It rebounded right there before it stalled out once again for the second time, and this is around the end of 2018, and it stalled pretty hard leading into 2019, as you might recall, and then it rallied back from 2019. Now, the first quarter of 2019, it stalled out again where it had stalled out previously twice before, and that formed the left shoulder. Okay, so it came down. The S&P came down to around 2750 before it rallied back up to a new all-time high in July of 2019, right around 3000. Came back down to form the right side of the head and rallied up. Now, this part here on the right shoulder, it's important. If you have a new high, if it passes the what you would have thought would have been a previous head, then that means that the head and shoulders pattern becomes invalid and it triggers a new buy point or a new rally. But because the rally stalled short of setting a new market high and then came back down, you have the formation of a right shoulder. And this head and shoulders pattern, again, is extremely predictive of the direction in the market. And what should have happened here with these two bottoms right here, and I've made a lot of money in the market based off of this pattern alone. If this pattern here off the bottom of the right shoulder, what should have happened was that we would set a new low right here, and then it would have continued to break this low and this low. And this really, once it breaks this low right here, the bottom of the left shoulder, that's when you know that it's really on. And it would move rather aggressively down to this first decline target. You would think it would settle back down here. And then, you know what, depending on what the market does, that's where you might see consolidation and maybe things in the market tend to start to steady out, or maybe they break. And if they break down again, you're going to be in for a rough ride. And so that is why, in my opinion, that is why the Federal Reserve initiated quantitative easing where they did. Because if they did not, then the market would be in a free-for-all starting from October through now. We would have been 3 months into probably what would have amounted to 20% correction, which is really what the point of this top here down to here is about a 20% decline. And that is typically the start of a bear market. And the bear market typically signals the start of a recession. And so because the Federal Reserve is not above inflating asset prices, we've seen that they've done this on a rather consistent basis through 2008, from 2008 through 2014, which has shown up in commodities and oil. It's showing up in the housing market as a result since then. And now it's showing up again in the stock market since 2008. They have a history of inflating asset prices. That asset price inflation is what's making us feel like, even though the market is doing well, we seem to be falling behind. We feel like we're not being able to keep up. People are now working for a living, but are not maintaining a household. 7 million people are homeless and yet not counted as homeless, even though they have a job because they're living out of their car. This is the type of These are the type of symptoms that are the result of meddling into a market in unnecessary and unhealthy ways, effectively inflating the asset prices in order to convince the American people that the economy is doing better than it really is. This is evidence right here, folks, ladies and gentlemen, that this is evidence that the economy is not doing as well as we believe it to be, and that your gut instinct and your feelings of that things just aren't right are in fact accurate. They are in fact accurate, and the new highs, this blow off top again in the market here. I would be very wary of that because it's we have had a head and shoulders reversal pattern. We've got bearish divergence that continues to grow, and at some point, the market is going to correct itself. And when it does, the further up it goes, the further down it has to fall. The next video I do is going to be on unemployment data. I did some research into the unemployment numbers, made some phone calls on that, and what I found was very disturbing. I'm finding lies everywhere I look, and it's very unsettling. And I think that really the only thing that we can do to correct this situation is to declassify government and open source our numbers. The Department of Labor should not be involved in collecting information and publishing data. The private market should be doing that for us, and we should have people competing to provide the most accurate information. We would all be better off for doing that. From a again, the Federal Reserve is manipulating the market. We would be better off by replacing that with a clean, green, citizen owned, and fully transparent credit union that is divested from oil and gas and invested into renewables and organics so that our central bank, our central credit union, is actually putting money to work to fight climate change. We will be able to issue new debt, which we would own and profit from, as opposed to the Federal Reserve, in which we own no stake in whatsoever. If we owned our credit union, we would be able to tackle climate change with no new taxes. We would be able to transition the economy to a sustainable footing with no new additional taxes because we would be able to change the price points of planet friendly products and services so that they are more competitive and less costly to the consumer than the polluting oil standard. That is the way, that is how we transition the economy into the future. That is the way, ladies and gentlemen, if you want to take action on the environment, if you want better numbers as an investor, we're on the same side here. And the way to do it is to turn the Federal Reserve, into a clean, green, citizen owned, and fully transparent credit union. My name is Joe McHugh. I invite you to go to libertystrikesback.com. I'm running for president. I'm on the ballot in 2 states. I will be on the ballot soon in New Jersey as well as in Pennsylvania. Would have liked to have already been on the ballot in New Jersey if not for a sprained knee, which is slowing things down. But I will be back out there very shortly, and we will soon double the number of electoral votes. Once New Jersey is on the ballot, we will have 14 and 29 electoral votes as from 3 states. If we win those 3 states, we can hang the Electoral College and force Congress to choose a bipartisan president and a bipartisan cabinet. Again, my name is Joe McHugh. Go to libertystrikesback.com, and thank you for your support and participation. Also, share this with a friend. We could use some help in growing the listener base and the movement.